Welcome to The Explainer. Have you ever looked at a giant corporation and just wondered what is actually going on in there? Well, today we're going to pull back the curtain on that incredibly complex machine. We're going to break down how it's built, figure out who's really calling the shots, and get to the bottom of its one ultimate purpose.
It's a fantastic question, right? Is it some all-powerful CEO, a secretive board of directors, or maybe it's just a bunch of anonymous investors somewhere? Well, the truth is, it's kind of all of the above. And to really get it, you first need to understand the two most important roles inside any major company.
And it all starts right here, with this fundamental split that sits at the very heart of pretty much every large publicly owned company you can think of. Okay, so on one side, you've got the owners. We call them shareholders. These are the folks who've put their money into the company. They literally own a piece of it. Then, on the other side, you've got the operators. That's the board of directors. Think of them as the pros who are hired to actually run the company day to day. So the owners get voting rights and a slice of the profits, while the operators are the ones making all the big strategic moves.
All right, let's make this a bit more concrete. To see how this all works, we're going to invent a company. Let's call it Sunshine Inc. Now, imagine Sunshine Inc. owns two totally different businesses, one that sells umbrellas and one that sells ice cream. Yeah, I know, it's a weird mix, but it's perfect for showing the kinds of challenges these companies face.
So the board of directors over at Sunshine Inc., they aren't just sitting around in fancy meetings all day. No, their job boils down to constantly making three core decisions that will literally decide the company's fate, and it's all about following the money.
You can think about it as a simple three-step flow. First up, the financing decision. This is all about where do we get the money? Do we borrow it from a bank? Do we sell off more pieces of the company, issue more shares? Then step two, the investment decision. What do we actually do with all that cash? For Sunshine Inc., that's a big question. Do we build a massive new ice cream factory? Or maybe pour that money into designing a high-tech umbrella? And finally, the dividend decision. When the profits start rolling in, how much of that do we give back to the owners?
So with all these massive, company-shaping decisions being made, what's the one guiding principle? What is the single, ultimate goal of this whole corporate machine?
All right, let's really dig into this phrase. The primary objective, and this is actually a legal duty in most countries, is to maximize the long-term wealth of the shareholders, the owners. And notice that key phrase, long-term. It's not about making a quick buck this quarter. It's about building real, sustainable value over the long haul.
And what does that wealth actually look like in the real world? Well, it mainly shows up in two ways. First, a rising share price over time. That just means the piece of the company that the owners hold becomes more and more valuable. And second, a rising stream of dividends paid out over time. That's cold, hard cash in their pockets as a return on their investment.
Now here's where things get really, really interesting. Because that very structure we've been talking about, the separation between the people who own the company and the people who run it, well, that can create a huge problem.
It's a classic issue called the agency problem, and the idea is pretty simple. The directors are agents who are hired to work for the shareholders, who are the principals. The problem is, what happens when the agents are tempted to do what's best for them instead of what's best for the people who hired them?
And this just lays out that core tension perfectly. The shareholders, the ones with ownership, they want long-term growth. But the board, the people with day-to-day control, well, they might be more interested in a bigger salary or a fancier office. Or maybe they'll shy away from a risky project that could be super profitable just because if it fails, it could cost them their job. See the conflict?
So what do you do about that? How do the owners make sure the operators are actually steering the ship in the right direction? How do you solve this agency problem? Well, this is where the corporate rulebook comes into play.
And that rulebook has a name, corporate governance. It's really just the whole system of rules and practices and processes that is designed for one specific reason, to make sure the interests of the directors line up with the interests of the shareholders.
Now, this rulebook has some pretty powerful tools inside it. Things like regular audits from outside accountants to make sure the books are clean. There's the ever-present threat that if the directors are doing a bad job, the shareholders can just vote them out. And then there's the big one, performance-related pay, tying their compensation directly to how well they do for the shareholders.
Yeah, let's zoom in on one of the most powerful and common ways to do that. Let's talk about executive share options.
Okay, here's how it works. It's actually pretty clever. A director at our company, Sunshine Inc., is given the option, and that's the key word, it's not an obligation, it's a right, to buy, say, 100,000 shares of the company in 5 years for a price that's fixed today, let's say £8 per share. We call that the exercise price. Okay, now let's fast forward 5 years. If that director has done a fantastic job running the company, what's happened to the share price? It's gone up, right? So let's imagine the actual market price is now £9.75. And this is the magic moment. The director can now exercise their option. They get to buy those 100,000 shares at that old, locked-in price of £8, and they can immediately sell them for the current market price of £9.75. That difference, that $1.75 per share, nets them a personal profit of $175,000. And boom! Just like that, their personal wealth is directly tied to the shareholders' wealth. When the owners win, the director wins.
So you can see how these corporate governance systems are like an essential bridge, right? They're built specifically to make sure that the operators, the people running the machine, are driving it in the exact direction the owners want it to go. But this whole thing leaves us with one final, really big question. If this entire incredibly complex corporate machine is legally designed to serve one single goal, making shareholders richer, then what does that mean for everybody else? What about the employees, the customers, the environment, and society as a whole? Who's looking out for the rest of us? That's definitely something to think about.